Hi there, Chris Gilmour here from Strategy First Financial Planning. Look, as we approach the end of the year, I've been reflecting on not just the year that we've had, but looking back to the start of 2020 and the last 3 years, and reflecting on the conversations that we've been having with you and the questions that have come up from time to time in those conversations. And more specifically, the question of, do I need to do anything? Do I need to change something? Do I need to react to something that is going on in markets or around the world at the moment? And what we want to explore in today's video, and I guess a series of 3 videos to come from us, is this idea of being active, right? And where it can add value to your financial position, but also importantly where it can detract from your financial outcomes. But today, for me, I'm really going to be focusing on this idea of our investor behaviour. So that question of, do I need to do something? It's human nature. We have this propensity to absorb the information around us from friends, family, colleagues, economists, other research we're doing, and feeling like we need to go and do something and change something. Okay, and so the idea of what is the impact that taking that approach can have on my financial outcomes and the achievability of my objectives. Now, what I've got up in front of us here is some research done over in the US. It's called the Dalbar study, looking at 30 years of investment returns to the end of December 2021. And on the right-hand side, we see the average annual return for the S&P 500, 10.65% per annum. On the left-hand side, we've got inflation, and in the middle, we have the average equity fund investor investing in that same S&P 500 market. Okay, so the same opportunity set, but being, importantly, active around their investment decisions. And when I say active, I mean implementing market timing strategies, buying stocks that they think will outperform the index and avoiding stocks they think will underperform, and generally being more active in their investment approach. And being active tends to come with emotionally driven decisions and making decisions based on things that are happening in our lives and around the world. Okay, and if we look at these outcomes, I don't want us to focus too much on the actual numbers themselves. It is the difference between the numbers that is the most important takeout from this slide. So the S&P 500 offering 10.65%, the average investor underperforming every single year for 30 years by 3.5%. Okay, it's a massive underperformance compared to what one might think is the easiest, most straightforward, simple investment approach there is, which is to maintain an exposure to a market index and keep that discipline. But it's not easy. Why is the average investor not able to participate in those types of returns? Why is the underperformance so significant? It's easy. It comes down to us as human beings. Okay, it's like we almost get in the way of ourselves achieving financial success because we let emotion and this feeling that we know that we can, or feeling that we can beat the market or make smarter financial decisions, or that investing in an index, as an example, is maybe a poor man's investment. Okay, but the average investor significantly underperforms. Now, if we think of why we're investing our financial capital, it's all driven by objectives. Funding a certain standard of living through retirement, not running out of money in retirement, potentially intergenerational wealth. So growing our money for the benefit of our kids, our grandkids, great grandkids, and so on. And we think about the achievability of those objectives, looking at a market index outcome compared to the average investor. And the achievability of those objectives is starkly different. On one hand, things look great. In the other, those objectives look completely unachievable. All right? So our role as a fiduciary for your financial capital, as your advisor, is to give you every opportunity, every chance of sitting in this camp over here. So participating in market returns, okay, giving you the greatest chance of achieving your objectives, and at all costs avoid being that average investor. Okay, and we all know that average investor. It's friends, it's family, it's colleagues, it's people that we know who are all trying to do this themselves. Okay, and by doing that, they allow that human nature component to come into it, and unfortunately, it clouds, it influences our financial decisions as it comes to our investments. And at the end of the day, more often than not, you are detracting from the achievability of your objectives. So what about more recently? What about 2020, 2021, what did things look like for the average investor there? So not looking over 30 years, what about more recently? Now, 2020, when markets fell 35% in February and March, a lot of people had time on their hands. They were sent home due to COVID. There was money in the bank. People had a lot of savings. And so people were investing more into markets with a great investment opportunity. But still, investors managed to underperform the index in that year by 1.3%. Okay, but still a pretty good year for the average investor, but still underperformed. Fast forward to 2021, and the underperformance of the average investor was worse than 10% under the market index. Okay, and so looking at that long-term data, some of you may say, look, I'm not going to be making those active decisions every year over 30 years and underperform by 3.5% a year. But I would say it doesn't need to be constantly active. It can be a single decision in a single year that has a massive impact over the long term. So an underperformance of 10% in a single year will compound, and it will have an impact on your ability to achieve your objectives. Okay, and so our job again is to help not just make smart financial decisions, but more importantly, as is reflected in these numbers, avoid making bad decisions. Okay, because those are the ones that will have a lasting impact on your financial position and ultimately your financial well-being. So hopefully you look at this data and what I've just gone through, and you see that there's some consistency in the conversations that we're having with you. You know, we might sound like a broken record, but talking about maintaining a disciplined exposure to markets, not reacting to things that are going on around us, like rising rates and inflation. All right, so maintaining a disciplined exposure, participating in the returns that markets are making available to us, and avoid making those decisions that maybe emotionally we feel like we should be doing, but at the end of the day are not in your best interest, are less likely to lead you towards your preferred outcome, and decisions we want to try and help you avoid. Now, what's next from Strategy First? So we've got another 2 videos as part of this series talking about this idea of being active and how it can either add value to your financial position, but also detract from your financial outcomes. In the first quarter of 2023, we're also going to be carrying out a client webinar that we'll be inviting you all to. We'll be reflecting on the year that was 2022, also looking forward to, I guess, a bit of a market outlook into 2023 and beyond. We'll be inviting some special guests to help facilitate that discussion and answer questions from those participating. But that's it from Strategy First for 2022. We look forward to partnering with you all in 2023 and beyond. Whilst we hope it's not as a volatile year as the one we've just experienced, if it is, know that we'll be by your side, helping you make those smart decisions, avoiding making those bad ones, and giving you the greatest chance of achieving that financial well-being, that we're all striving for. Anyway, take care for now, and see you in the new year.